This conference will now be recorded.
All right, everyone, welcome to this edition of Traders Exchange. As always, everything that we're going to be talking about is for educational purposes only, and nothing is intended as any type of investment advice. All right, so this round of class has been going real well, but it's one of, like I said, it's one of my favorite topics that we've been talking about, and it's how to interpret prints based off of the puzzle, based off personality, and really, essentially how we learn how to trade and the things that we need to have in our minds. So moving over to now, we have, like I said, we have 3 questions, it looks like, and all of them, pretty decent. So let's start with Matt's from yesterday. So I feel like this has already been answered, and but how can big levels on the level 2 be interpreted? This seems very far away. There has been 40,000 shares sitting at a spot since 10 a.m. on PG. Obviously, big money is sitting there. But what can we do with this information? Is this the same as seeing a big order on the matrix? And then if it is, then sorry for the confusion. Okay, so essentially level 2 and level in the order book right here. So that's, our matrix and our level 2 are the same exact thing. The only difference is that your matrix actually aggregates it. All right. So like if we look over here at 4571, we can see we have 600 shares. But in all reality, there's 2 people. So there's one person that has 500 shares. There's one person that has 100. So essentially, it's just the aggregate of all of the orders at that level that come into your actual matrix itself. So essentially, what you're asking is, yes, same exact thing as seeing it on your matrix coming up. So if you see it on your level 2, it's going to be in the same spot as the matrix. It's just one is going to be aggregated and one is obviously going to be broken down for each specific order that's out there on each different exchange. For instance, the NASDAQ, you can see 162 shares, 100 on the BATS. On the Edge, we have 200, 100. ARCA, we have 100. So that's really the only differences between our level 2 and what our matrix is going to look like. Now, in reference to what you were talking about, so there's been 40,000 shares sitting far away. That's kind of interesting because you see that happen every once in a while. And a lot of the times what ends up happening is that we end up seeing it start to act as a magnet and start working back towards that order. Now, that's not something specifically that we can just trade off of. For instance, if there's, the stock is at 650 and there's a 50,000 share order sitting at 5, it's not really going to tell us that we're going to be shorting it till 5. Obviously, the prints are going to be what tells us that. But there's usually a reason that you see a big order out there. It's funny because back, I'm going to have to say maybe like 7, 8 years ago, you used to see during the pre-market, you would see some type of ridiculous order out there. So let's say, like, for instance, if it was LK, someone would have like a big buy order in there during the pre-market, and it would be at like 32 or 25, something just completely absurd, where if it actually got filled, they would be immediately up a huge amount. That was actually before. It used to be too where you could actually market order, and I know a lot of platforms don't let this happen anymore, but you literally would be able to market order in the pre-market. So they'd put those orders out there and just hope somebody got trapped in it. Hope somebody that didn't know what they were doing ended up executing something at that level. And that's not exactly what we see going on here. But when there is a big order, it's something to keep an eye on. All right. So if you see, like, for instance, like I was saying, let's say we have, we're sitting up here at 48, but at 45, we have a huge order sitting there. It's going to tend to gravitate towards it. So just interesting. Let's look at PG real quick. So the order in PG was at 125.64. All right. And look, not really doing much. So unfortunately, and do we have anything there? No, it's not really showing any big orders now, but if we look at it, it really hasn't had that much of an effect, except the fact that it really, this was at, I don't see a time here. No, yes, I do. 12, looks like 12:59. So 12:59, if we look, it was pretty much almost right there. Yeah, excuse me, 111. Yeah, 111. So, would I be shocked to see it gravitate back towards there? No. And at the same time, because 125, big psychological level, hard level to hold up, it's just a little variable to look at. It's not something that's going to add a huge percentage to your trade. It's not really that much, But when you do see a big order out there, make a note of it. See what happens, see what the prints are showing compared to getting to that order, and kind of take it from there. But like I said, it's not anything that's going to add 20% to your trade. It's just something to keep an eye on. All right, make sense? All right, so I'm gonna assume yes. All right, moving on. I like this question a lot. Okay. All right. So, hey, Rich, I've been having this reoccurring problem in which when I'm picking trades, I pay more attention to the variables that tell me not to take the trade than those that are telling us what's likely to happen. But I would think that there's always a reason we could think of not to take a trade. Is there such thing as weighing the possibilities in the trade, or should I have always have a sometimes wrong, never in doubt mentality? All right, so that's actually an absolutely phenomenal question. So last class that we did, the before this round, the one that we did end of November, okay, we talked a lot about percentages, okay? So I want you to understand something. In every single stock ever out there, 99.99999% of the time can find a reason in a trade not to take it. Okay, and when I say not to take it, I just mean a negative variable. I don't mean that the variables are adding up to be negative and it's a bad trade. I mean, there's literally always going to be negative variables within your trade. So that's not the way that we can look at them. Okay, what we have to do is we have to look at the percentages for the trade. Okay, and what I mean by that is, first of all, number one thing, guys, what gives us 60% in our trade? What variable gives us 60% to our trade? Show of hand, prints, right? Those prints are going to give us 60%. If we had nothing else but prints, we would be right trading those prints 60% of the time. And that's literally without having any other variables within the stock. That means we're not looking at literally anything. It's just the stock. Let's say if we have, 10 prints at, in this case, let's go back to, okay. But if we have 10 prints at 45, okay, statistically, there's a 60% chance that without anything else, that this stock will end up going back underneath 45. And then, I mean, sometimes it might even be higher than that, depending, as we know, we can get more than 60%, but that's our average. Okay, and then from there, what we do is we start building variables. All right, and what I mean by building variables is we find things that are positive towards the trade going in the way which way we're looking at it. Okay, now we know what's another thing that gives us a big percentage of our trade. Okay, up to 10%. Okay, so it could technically go a little bit higher, but for the most part, up to 10%. Yes, our trigger. Okay, our trigger is going to be a huge indication of what, the trade becoming 60% to going to 70%, because technically at the end of the day, all you need is controlling prints and a trigger in order to take a trade. Okay, but 70%, and remember, sometimes the trigger is not going to give us a full 10%. Sometimes the prints aren't going to give us a full 60%. So now what we need to do is we need to find other variables that add to those percentages. For instance, a trend. For instance, off-level prints. For instance, a double top, a volume pattern that's coming into it. Every other variable that we've talked about on how to add percentages to that trade. So what happens is once that trade hits 70%, can we take it? Should we take it? Once those variables add up to 70%, should we now take it? Yes, absolutely. Okay, now keep in mind, 70% is my number, okay? If your percentages aren't where they need to be, you need to go higher. Okay, so you're going to want, let's say if you're, having a little bit of difficulty, you can't be taking 70% trades because it's a great trade, don't get me wrong, but it's not leaning you as far as it could. So you might want to look at taking only 80% trades or 85% trades. And of course, are you going to miss certain trades, certain great trades that are over 70% and end up working out great? Of course. But you're going to, if we counted every trade that you've missed throughout the course of a day, it would be ridiculous. So we have to look at the percentages for that trade working out, not the negatives. Because what would end up happening if we started taking off percentages for every negative and every positive? What would end up happening? Would we ever make a trade? Exactly. You're going to get stuck. You're not going to, you can always find something that's not perfect. Okay, and don't get me wrong, you get every once in a while, you get that perfect trade where it's just nothing else could happen but that's, those are our gift trades. Those are kind of few and far between. We're not going to be seeing those things just popping up left and right. Okay, so we have, we technically could always wait for those trades and we'll have a great consistent career. We're just not going to do a lot. So really what you need to do is you need to be building the percentage towards the trade, towards the direction that you're looking to go, not by subtracting negatives, because there's, like I said, there's always going to be negatives in a trade. You know, for instance, right now, if we were talking about negatives, technically we wouldn't even want to take a trade. It's 1250 right now. Is 1250 a good time to be taking a trade? No, right? It's not really at all. But are there still great trades that happen at 1250? Of course. We've seen it multiple times. You know what I'm saying? So there's always something. So what the key to building your percentages and building your consistency is getting those percentages in your trades for the way you're looking for. Okay. And when I say that, what I mean is finding the dominant market maker. Okay. And it doesn't always have to be the dominant market maker. Of course, we would rather follow the dominant market maker. But sometimes if you get 5 prints, that's going to be a great trade, right? But is 5 controlling prints going to be a dominant market maker? No, right? They're still a good person to follow. They're just not the dominant market maker. You know what I'm saying? So from that, you know, when we get our controlling prints, from there, we now know the person we're following. Now we need to make a case to continue to follow that person. Obviously, the trigger is going to be the #1 case that we could make in order to take the trade. Okay, but then all the other variables that come into it are making a case for why that person is going to be correct. Once you're over 70%, you could take the trade. But once again, like I said, you know, if you're in the beginning stages of your trading, I would go higher, because if you think it's 70%, what's it more than likely? If you're a brand new trader and you think it's 70%, what's it more than? You hit 50, 60, somewhere in there. So in the beginning, you start higher, and as you start to prove your percentages within your numbers, because remember, this is just a business. So once your numbers start getting, you know, start becoming proven, where I think it's 70% and it's working out 7 out of 10 times, well, guess what? Now you're on point. Now that 70% trade, that's perfectly fine to take. When it's 80, it's actually 80. When it's 90, it's actually 90. Okay, if a trade has 90% within its variables, I don't care what negatives are there. Do we click the button? If a trade is 90%, I don't care what variables, do we click the button? Always. There's no question. There's no mind, there's no thinking, there's no thought process. There's 90% trades we take. That's that simple. Because are you going to get a ton of 90% trades every single day? You're going to get a few, but you're not going to get a huge amount. So when those come up, those are gifts. And when we get a gift, we accept it. We don't want to, you know, look the gift horse in its mouth, for lack of a better word, you know, way of saying it. All right, make sense? But that's how we go. We can't be looking at those negatives, because what will happen is we'll never end up taking a trade. We want to build a case for the show of hand that we're looking to follow. Okay? That's literally, at the end of the day, it's where we're building a case with the variables around to add percentages for that person to be correct. Because we know they're going to be correct for the most part anyway. And then when we add those things into it, it raises our percentages. It raises our ability to be consistent within our actual trading. Gift mini horse. All right, I think we're already on the 3rd question already. But that's a very good question. I mean, that happens to a lot of people, and I see it all the time. I've taught so many people before. I've millions of people. What happens is they get so caught up on finding things that a reason why the trade's not going to work out, that they completely ignore the 10 other reasons that said it will work out. You know what I'm saying? So if you know, and don't get me wrong, at the same time, guys, if there's 10 reasons, so the trade tells you it's 70%, but there's 10 reasons why it says it's not going to work out, is that going to be a good trade? I mean, this is just common sense. But is that going to be a good trade? Even if it says 70%, but there's 10 reasons that it's not going to work out? No. If that's happening, I mean, that should not be happening that often, but if that is happening, and you see that happen, you know, #1, what I would do, okay, is I would take a feeler. Okay, whenever I'm kind of like a little bit, if like the trade percentage gives me what I need, okay, but there's just so many other variables that come into it that really don't look good to it, what I'm going to do is I'm going to lower my shares big time. I'm going to take a feeler position. Because guys, if I take a feeler position, okay, and let's say it goes against me, is that a big deal? Is that a big deal at all? No, right? Because what's going to happen the next trade I make at regular shares? Is that going to ruin my day by taking a little bit of a loss on basically no shares on a feeler position? And obviously, a feeler position is different for every single person. There's market makers out there, feeler positions 50,000 shares. There's people out there, feeler positions 1 share. You know what I'm saying? But what works for your account, what you see as a feeler, that's the way I would go about it. Or at the end of the day, you could always just not take it. Okay, but I like to get in the habit of when the percentage is there, not thinking about it. Okay, because then otherwise, once again, like I said, you're really gonna get caught up mentally and continuously going back and forth with yourself. Okay, if the percentages are there to make the case 70% or higher, it is perfectly okay to take. Okay, and then as you get really good, sometimes feel comes into play, and you might start to use 60% trades. Every once in a while, there's a 60% trade out there that just really has a lot, has a lot going for it. But it's still, you can only assign that 60% to it. With clarifying question in print, 60-ish% without or without the pullback pull-up. I'm not sure what you mean. Just clarifying question, is print 60% without or without pull-up? You're going to have to explain that a little bit better for me. Do you mean like 60% with, like, even if it doesn't pull up? I think I know what you mean, but I'm not sure. Okay, so no matter what, okay, if the stock, the show of hand we get, and it shows that we need to get a minimum of a 50-cent pullback. Okay, let's use this as an example. Okay, we come in, we have so 45.50 right here. We see 5 bid prints. Okay, 5 or 6 bid prints. Okay, what is that telling us? So let's interpret those prints right now based off of the personality. How much should it pull up from those 5 to 6 prints? Yeah, really would probably start. I mean, the range today, Amy, is big, so maybe a doubt, but I would say 50 cents conservatively. We're going to be looking for about 50 cents today. Obviously, it's a little bit of an exception, and we see a little bit different coming into there. But if that tells us from 46.50, okay, it needs to pull up 50 cents, what number does it need to go to? Let's use simple math. Excuse me, 45.50. It needs to go up 50 cents. What number does it need to go to? 46. So technically, can it be a high percentage trade if it is not above and or right by 46 when we get the trigger? Can it be a high percentage trade? Nope, absolutely not. If the show of hand you see shows you it needs to pull up 50 cents, it needs to pull up 50 cents in order for it to be high probability. Okay, if it shows you that it needs to pull up $1, it needs to pull up $1. Taking a trade anything below that, okay, really is taking away the percentage of your trade. Because that person, when they came out and showed you that I'm going to be building here, they, based off of everything that we sit there, our screen time, our percentages, everything that we do day in and day out, if it does not do what they showed us it was going to do, now it's not following the rules. So if it's not following the rules, our percentages are drastically decreased. Okay, so at that point, this, it always, you got to think, okay, for the first 5 years of my trading, if it did not do what it needed to do, I could not trade it. It's that simple. There's plenty of stocks that would start running and move $5. That's great. Okay, I don't care if a stock moves $5 and it didn't follow any type of rules for a high percentage entry and you didn't catch it. Good, you shouldn't have caught it. Okay, that's one of those kind of shot from the hip type situations. And can we get a thing? Consistency, consistency, consistency. That's the most important thing that every trader needs to have. So can we be consistent shooting from the hip? Can it happen? No. Why do you think people literally don't shoot guns from their hip? Because it's a stupid way to shoot. It is not high accuracy, it's not high probability, and you will not consistently hit your target. That's why I love using the term shot from the hip, because that's literally what it is. It's almost a guess. All right, so yes, the stock needs to follow your rules. It's that simple. If it doesn't follow your rules, what do? We find a stock and it's not following its rules whatsoever. What do? Move on. Find a stock that is. Rich, do proper riders after prints add 2% or 5%? It depends the riders. They could technically, Anthony, go up as high as 5%, okay? But it really just depends what the situation. If you get like 2 or 3 riders that come in, well, you know, that's like barely 2%. It's not going to affect your trade that much. But if you see someone that's actually coming in and taking a good position relative to what the way the stock is printing, okay, that could add up as high as 5% into the trade. Absolutely. I wouldn't go anywhere over 5%, but it could be up to 5%. Remember, every single situation is going to be relative to what the personality and what the puzzle is. You know what I mean? So like right here, let's say we needed a pull up right here, 45.50 and 45.55. Is this going to add any percentage to our trade right here? No, it's not going to mean anything. This is nothing. I can't add any percentages because of these 2 prints that are coming in there. But if we came up and had like 50, I don't know, 45.51 through 41. 45.54, we saw, you know, 6 or 7 prints off level come into there. Is that going to add a big percentage to our pull-up trade? Absolutely. So see the difference there? It depends what we see and what it is relative to everything else that we have going on out there. You know, at the same time, guys, like for instance, right now, you could get some great riders that come into this. Is the stock going anywhere? Great riders could come into LK right now. Is it not going anywhere? No, it's no volume. It's not trading anything. There's literally no trading going on in it. So, you know, it's the puzzle. Okay, it's the personality / puzzle, and that's what we need to look for. All right, so we need to see, you know, is it what relative to what's happening and what's actually going on. Twitter's getting a huge amount of volume, by the way. Let's take a look real quick. Yeah, it's some big volume. All right, guys, that makes sense? Any questions? Are we good to go? Good, beautiful. All right, so I know this is going back to the basics, but I was wondering if you can give a review on your ratios and what you're willing to lose on $1, $2, $3, and $3 trades, and why you're willing to lose a certain amount. Thanks for all you do, Anthony. All right, so okay, the ratio is always going to be 1 to 4, 1 to 5. So it doesn't matter if it's a $10, if my price target's for $10, it doesn't matter if my price target is for $1. Okay, 1 to 4 would mean on $1, I can either lose how much? 25 would be the max, and 20. So if I'm taking a 70% trade, I'm probably going to keep it a little bit tighter, probably go more closer to the 1 to 4 part of it. But if it's, you know, an 85% trade, I'm probably going to give it a little bit more leeway. That extra 5 cents a lot of times is a real big deal, especially when stocks are coming down to levels. Okay, now that's a great question. Why is this the ratio of what I allow myself to lose? Well, the way I think about it is that all trading is risk versus reward, right? All right, would anyone here be willing to lose 50 cents to make 50 cents? Would that make sense as a trader, as owning a business? Okay, as a business, would you be willing to lose, or let's just like make it let's break it down as a business. Let's say you're looking at a marketing budget. Okay, is anyone out there going to be willing to spend and hire somebody for, let's say, $5,000 for the month to only make $5,000 for the month? Would that make sense? No, that would be dumb. That's just, you know, I'm just using any numbers, but it's stupid because you're never accomplishing anything. Okay, that's why so many traders out there actually end up treading water. They don't really lose that much, but they don't make anything either. So, you know, it's even more frustrating because at least if you're losing, you know, there's something that you could do. It's even more frustrating to literally go a year and just have the same amount in your account. I mean, in my opinion, I would think that's the way, way it would go, but doesn't make any sense. So the reason I use 1 to 4, because I think, I base most of what I'm looking at for 50 cents. I know most of the things that I am looking at will go more than 50 cents, but that's what I base it on, because 50 cents to me is that perfect sweet spot. To look for a trade for 25 cents. By the time I actually get in on my entry on the trigger, okay, and then by the time it starts to play games around that 25 cents, how much can I really make on a stock that's 25 cents? So if I take a trigger on a stock that's only going to move 25 cents, how much can I really make? Even let's say I'm perfect. What's like the max, that perfect trade that I could make on that? Yeah, I would say 20 would be that would be if everything just worked out completely perfect in that situation. Okay, and that's perfect. Really, what it is about 10 to 15 cents, like you said. Okay, it's not a lot. Okay, and once again, exposure in the market, guys, is a dangerous thing. The market, I'd be the first person to tell you this, is a dangerous place. There's sharks out there. Okay, there's people that literally their whole job is to steal your money. That's what they want. They want your money. So that, to me, there's just not enough room for error within a 25-cent trade. But now let's break it down to 50 cents. Okay, so a 50-cent trade, okay, would it make sense to lose 25 cents with a possibility to make 25 cents? Keeping in mind that if the trade needs to move 50 cents, am I actually going to make 50 cents? Unless I'm perfect. But once again, our tops and bottoms for us? No. Guess who's at tops and bottoms? No, yeah, the market makers we know for a fact are sitting at those points. Okay, so right there, that doesn't make much sense either, to lose 25 cents. Okay, but what about, okay, a stock that's going to move 50 cents, 10 cents? Why does 10 cents make sense? Why does that make sense? Yeah, it's risk versus reward is just perfect. It's over 100%. So obviously, if I'm only going to lose 10 cents, I can't only be looking to make 10 cents. If I'm only looking to lose 10 cents, I can't be looking to make 20 cents, because if I'm looking to make 20 cents, guys, technically, and this is where it comes down to, technically, if I'm looking to make 10 cents on a trade, how much am I actually going to make? I don't know, 6 cents? Somewhere, remember, basically that's every dollar that the stock moves, we're looking to make 60 cents for every dollar. That's really what the trade. That's where the kind of, based off of triggers and everything, the way that the market moves, for the most part. Okay, 60 cents per dollar is how much you're going to take from a trade. Now, keep in mind, that's for a dollar trade, because if 60 cents per dollar on a $5 trade is a lot different. But on per dollar trade, we're probably going to end up taking about 60 cents there. So really, I can't lose. It's just saying I'm going to lose 10 cents. It's actually putting me open to lose a lot more, because am I actually going to make that dollar? No. So really, 1 to 4, 1 to 5, what that does is it allows for us to take that in. So we know on a 50-cent trade, we're probably only going to make 30 cents. So it really almost comes down to 1 to 3. And if we're perfect, it will be that 1 to 4, 1 to 5. Does everyone understand what I mean? We're not going to hit our tops and bottoms. So, the best type of trade, you're going to make more than 60 cents per dollar on a trade that moves $5, because a $5 trade's a lot easier to hold, especially once you really get away from where your entry is. It gives you a lot more leeway to kind of play around, to be able to add, to be able to do other things. But when we think of just a dollar trade, okay, once we get the trigger, let's say it's LK, guys. A trigger in LK is gonna be about what? How many cents is a trigger in LK gonna be? Yeah, somewhere in that vicinity, right? Right, Andy? It's going to be somewhere around 25 cents, somewhere, right about that. So right there, if I'm only looking to make $1, I only have the ability now, after hitting the trigger, and that's if the trigger happens at a perfect level, okay? I right now only have the ability to make 75 cents when you really think about it. Okay, unless once again you somehow use perfect, but it's just trading doesn't work that way. I would love to say it does, but it doesn't. Okay, so 1 to 4, 1 to 5 is just the perfect amount that gives us the perfect risk versus reward. All right, because I literally can't, any other numbers don't really make sense. You know, if you're talking about 1 to 6, okay, now things just start getting weird. It just, you know what I'm saying? It's the perfect fit for the way that the market works to use that 1 to 4, 1 to 5. Perfect risk versus reward ratio. There's no a better one that I've ever seen. There's no better one that I could give you because over years I've kind of worked it out, and it's just the way the market works. So 1 to 4, 1 to 5. Okay, because you got to remember, okay, 20 cents, okay, 25 cents. We need to do, well, that's a big thing too, is easy for doing the math. It's instant, okay? If we start going to 1 to 6 ratios and all of a sudden, don't get me wrong, it's not terribly hard math, but you know what? Things need to be easy. Remember the KISS method, keep it simple, stupid? Keep it simple. It's a perfect ratio, and it's easy to do. For every dollar, 20 cents to 25 cents. Okay, does that mean that every once in a while we're not going to cut a trade off at 10 cents or let a trade go to 30 cents? No, of course, it's going to happen. But that's where our basis of our foundation needs to be. And 100%, yeah, I mean, this stuff is all instantaneous because you got to think, okay, once a stock, okay, so let's use easy numbers. Let's say 45. We have 15 bid prints that came in. 15 bid prints in a stock like LK should pull the stock up how much? $1. Okay, easy conservative price target would be what in this case? So bid prints at 45. Yeah, so 46 would be for the pull-up. I mean for the actual trade itself. It's kind of a trick question too. But what do you think? What would be the easiest conservative price target? Can we have a price target under 45? So we technically know it needs to go under 45, but what has to be our price target in this case? 45. It has to be. Because 45 is, we're going to see games, we're going to see prints that come in, and no matter what, we know it needs to go further, but that's conservative. We know if we're at least 245 before the games start to be played, okay, and someone comes out there and tries to steal our money again. So we would actually only have to go from 45. So you got to understand something. Do stocks pull back exact 50 cents in dollars each time? Or sometime at like 89 cents, sometime at $1.12 or something. No, so we have to be able to do instantaneous math once we get in on the trigger. Okay, now it's very easy, okay, to do that though, because as the stock is pulling up, okay, we're gonna be looking to short it. So when the stock comes to 45.50, okay, what are we gonna do? Stock comes to 45.50. Remember, 15 prints sitting at 45 needs to pull up $1. When it comes to 45.50, what do? Yeah, we move entry because we don't do anything there. Remember, it needs to pull up $1, so it's a low percentage trade triggering off of 45.50. But what we're going to do is we're going to have an order sitting probably somewhere right here within like the 45.71 area, 45.71 to like 45.78, somewhere in there, depending on how quick you are. And then what happens when it pulls up to 46.50? Well, we move our order. Once we put our order in there, we know exactly what our stop loss is. So the second that trigger comes in, we already know exactly how much we're able to lose before it even goes because our order's already set. If you're waiting, I'm going to tell you something right now. If you're waiting for a trigger to happen to then enter and put in your entry, you're missing the boat because it's just not going to work out. You continuously find yourself getting very late fills. And guess what? What happens? What happens when you get late fills? If you're not in close to the release and you wait till after the release, what happens afterwards? Yeah, we start to see games, we see broken keyboards, screens, whatever you like to, whatever your choice of breaking things is, that's what's going to end up happening. So these orders need to already be set before it happens. It's the key to anticipating. It's the key to being ahead of what the chart is because you know where realistically, where the print showed you, you know exactly where it needs to go from there. Okay, so like for instance, 15 prints at 45, we know it needs to at least go up $1. But that doesn't mean it's not going to go up $3. We just know on if we were to average everything else out, okay, what happens is on average it will only move about $1. Okay, so that's where we first need to be ready for. Okay, but then after, if it continues up, you just continuously move your order. Just move your order, just move your order. Boom, trigger, click the button. You're already set. You already had your order in, so you know exactly what 25, 1 to 4, 1 to 5 is going to be from there. Very quick math. And that's how you trade. It's really, at the end of the day, exactly what it comes to. We're still new to TradeStation. Can you show an example of the quickest efficiency way to move your order? Really like this. You click. So if you click right here, this is how, like, if you click on the level 2, this is the quickest way to do it. You've like 45.15, see it goes in there, but if I go over here, 45.38, it goes right there. That's the quickest by far way to change your orders, because when you type, as we all know, we fat finger things. So like if you want to do like 45.18, you could type it in. It's just, but at the same time, guys, when you're anticipating, okay, you're anticipating a move happening, you should know exactly what your next order you're going to have to put in is, don't you? So if the stock is only supposed to pull up $1, but now it's going up to $1.50, shouldn't you already know exactly what your order is? Of course, right? So it gets easier once the market's kind of slower. But in the morning time, I'm going to tell you, I almost 90% of the time have to use the clicking the level 2, because things just happen so quickly. And when I know a stock has, a $3 possibility for a move, I'm not going to bitch about 15 cents of my entry. You know what I'm saying? Sometimes it's, penny smart, dollar foolish. Well, that happens a lot of the time. In the morning time, if I know I have a huge high percentage trade that's going there, I'm not too worried about a perfect entry. I mean, don't get me wrong, I'm always going to try to have the perfect entry, but I'm not worried about it. It's not a deal breaker for me because it's not a big deal. Okay, even a stock that's going to move $1, an extra 10 cents, I don't really care that much, because at the end of the day, you want to miss $1 trade, okay, over 5 cents of your entry. Is that a smart way to go about it? Of course not. You're not going to miss an easy trade like that over 5-6 cents. But I'll tell you right now, and I know for a fact all of you have done it before, because so have I. I've done that many times. Okay, you get greedy and you want to make that extra 3 cents or that extra 7 cents, and you miss a trade because of it. It's stupid. It's just, there's no reason to do it. So we need to be aware of that. Okay, but when you have a monster high percentage trade, I don't care what has to happen, I'm getting into it. I don't care if my product, like I said, I got to give up 10 cents, give up 15 cents to make sure that I'm in. Got to be in it. Because remember, we talked about it earlier. Do we get a lot of 90% trades out there? Get a couple every day, but you're not, it's not something that just, we could go out there and just pick a 90% trade at any given time that we feel like. It's not gonna, it doesn't exist. So just keep that in mind when especially when your percentages are higher, you want to make sure that you are in there. Okay, it's very important that you're in the trade to be able to make any money. I don't know if everyone knew that, but you actually have to be in order to to make anything. All right, guys, any questions? Any questions? That does it for dates on the next onsite. All right, so it's going to be, I'm going to be finalizing it at the beginning of February, but it's more like 90% going to be either the second week of June or the third week of June. Okay, and it will be on a Tuesday, Wednesday, Thursday, rather than Wednesday, Thursday, Friday. But then that also gives you guys all the time in the world to go enjoy the city before, after, or whatever. But I got a lot of cool stuff planned for that. But we'll go over that once everything's locked in. I have some really cool stuff that we're going to be doing. All right, guys, so that's it for me. I will talk to everyone in the chat, and happy trading.